The last time the housing market looked like this, it triggered the worst financial crisis in a generation. And right now, in 2026, the same warning signals are flashing again. Different causes. Same destination. Most Americans have no idea what's about to happen to the value of their home or how fast it can move. In the next 10 minutes, I'm going to show you exactly what's happening in the housing market right now, why the collapse is already underway in certain markets, and the 3 moves that will either protect your wealth or position you to profit from what comes next. Let's start with the number that should be making headlines but isn't. Mortgage delinquencies have risen for 6 consecutive quarters. Not just in one region, nationally. And in the markets that led the pandemic housing boom, Austin, Phoenix, Tampa, Boise, home prices are already down 15 to 25% from their 2022 peaks. That's not a correction. That's a crash in slow motion. Here's the mechanism most people miss. During the pandemic, the Federal Reserve dropped interest rates to near zero. Mortgage rates hit 2.65% in January 2021, the lowest in recorded history. Millions of Americans bought homes or refinanced at those rates. They locked in monthly payments they could actually afford. Then the Fed raised rates 17 times in 24 months. Mortgage rates went from 2.65% to over 7.5%. On a $400,000 home, that rate change increased the monthly payment by over $1,200. Every single month. The market froze. Buyers couldn't afford to buy at the new rates. Sellers couldn't afford to sell because selling meant giving up their 2.8% mortgage and replacing it with a 7.5% mortgage on their next home. This is called the lock-in effect. And it created one of the most dysfunctional housing markets in American history. Now here's where it gets serious. The lock-in effect reduced inventory to historic lows, which temporarily held prices up. But it couldn't hold forever. And cracks are appearing everywhere. New listings are up 42% year over year in key markets. Homes are sitting unsold for 90, 120, 180 days. Price reductions are accelerating. And mortgage applications, the leading indicator of future sales, have collapsed to their lowest level since 1995. Meanwhile, the foreclosure pipeline is filling up. COVID-era forbearance programs have long since ended. Homeowners who stretched to buy at peak prices in 2021 and 2022 are now underwater on their mortgages. In markets like Memphis, Atlanta, and Las Vegas, foreclosure filings are up 60 to 80% year over year. This isn't shadow inventory yet, but it's becoming shadow inventory. And when distressed sellers hit a market with falling prices and frozen buyers, the math gets ugly fast. Let me give you the historical pattern so you understand where we are on the timeline. In 2006, home prices peaked nationally. The warning signs were identical to today: rising inventory, falling sales volume, extending days on market, early delinquency upticks. Most analysts said the market was just normalizing. They were wrong. By 2008, prices had dropped 20 to 40% nationally. By 2010, 9 million Americans had lost their homes. Here's the critical difference between now and 2008. The subprime crisis in 2008 was driven by bad loans, people with no income, no assets, getting mortgages they could never repay. The underwriting is better now. Most people who have mortgages today qualified legitimately. They can make their payments, for now. What's different is the affordability collapse. The median American household income is around $78,000. The median home price nationally is still above $400,000. At 7.5% rates, that requires a monthly payment of roughly $2,800, consuming over 43% of gross income. Financial advisors say housing should never exceed 30%. We're at 43%. When affordability breaks, demand destruction follows. And demand destruction drives prices down. So what does this mean for your specific situation? If you're a current homeowner, here's what you need to know. Your home's value is real only when you sell it. If you bought in 2020 or earlier at low rates and have significant equity, you are protected for now. But if you bought at peak prices in 2021 or 2022 and put less than 20% down, you may already be close to negative equity territory in certain markets. Run the numbers now. Don't wait for the quarterly Zillow update to tell you. If you're a prospective buyer who has been waiting, here's the uncomfortable truth: waiting may be the right call. When affordability is this broken, prices historically don't stabilize until either rates fall dramatically or prices fall significantly, or both. We don't know which comes first. But buying at the top of an affordability broken market carries real downside risk. 3 moves to make right now, regardless of where you stand. Move 1. Calculate your real equity buffer. Take your home's current market value, use actual recent sales of comparable homes in your neighborhood, not automated estimates. Subtract your remaining mortgage balance. Subtract selling costs, typically 6 to 8%. That's your real equity. If that number is less than 20% of your home's value, you have limited cushion if prices continue to fall. Move 2. Stress test your mortgage against income disruption. If your household income dropped 30%, one spouse lost a job, a business slowed down, could you still make your mortgage payment? If the answer is no, that's a vulnerability you need to address now. Options: build a 6-month mortgage payment reserve, reduce other debt obligations, or consult a HUD-approved housing counselor about your options. Move 3. If you're renting or sitting on cash, position yourself for the buying opportunity that's coming. The best time to buy real estate in American history was 2009 to 2012, when prices were low and almost no one had the cash or confidence to buy. The next window like that may be approaching. Build the largest cash position you can. Stay out of the market until affordability math makes sense. The people who win in real estate crashes are those who were patient, liquid, and ready when opportunity arrived. Finance Alert Global publishes these alerts before they become mainstream news, so you have time to act. Subscribe now. Share this with anyone you know who owns a home or is thinking about buying one. The market doesn't warn you when it's about to move. I do. Subscribe. And I'll see you in the next alert.